What if building life-changing wealth didn't require a huge upfront investment, but just $3 a day, 5 days a week? That's $15 per week quietly working in the background, compounding over time, and moving you closer to real financial freedom without stress, speculation, or market obsession. In today's video, we break down ETF investing and reveal 3 high-growth ETFs designed for long-term wealth building using a simple, realistic approach anyone can follow. No lump sums, no market timing. Just a disciplined buy-and-hold strategy powered by consistency. I'll show you and Bobby these 3 high-growth ETFs in reverse order. The first ETF can turn $15 per week into over $650,438. The second unique ETF can turn $15 per week into over $914,378, while the third ETF can turn $15 per week into over $1,776,856. And at the end, I will show you and Bobby how the combined portfolio of these high-growth ETFs could potentially generate a whopping $3.4 million. If your goal is investing smarter, not harder, this is where it begins. Welcome to Investments Mindset, where wealth builders come to get inspired. Before we continue, please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Let's dive in. The best ETF for 2026 isn't about chasing hype or guessing trends. It's about owning resilient ETFs with strong innovation exposure and the ability to compound into meaningful passive income over time. High-growth ETFs make long-term investing accessible, even if all you can commit is a few dollars a day. Real success in ETF investing isn't about timing the market. It's about time in the market and letting compounding do the heavy lifting. As Warren Buffett famously said, the stock market is a device for transferring money from the impatient to the patient. If you want steady growth, compounding returns, and a system that fits real life, these high-growth ETFs could completely change how you invest, starting with just $15 a week. Firstly, it is important to know that identifying the 3 best high-growth ETFs for 2026 means looking beyond headlines. High-growth ETFs should be evaluated using a blend of metrics, including at least the 10-year performance, expense ratios, sector exposure, and the long-term growth potential of their underlying holdings. Many top contenders focus on innovation-driven sectors such as technology, clean energy, and emerging markets, areas with the power to fuel long-term expansion and passive income. Coming in third on our list is the Vanguard Information Technology Index Fund ETF, ticker symbol VGT. This ETF represents the core of disciplined ETF investing, offering broad exposure to the U.S. technology sector through Vanguard's proven, low-cost approach. VGT is passively managed and tracks the U.S. information technology industry, giving investors access to the companies driving innovation in software, hardware, semiconductors, and electronics across the digital economy. Its holdings include large, mid-sized, and smaller U.S. firms, all classified under the Global Industry Classification Standard. Rather than trying to beat the market, VGT stays aligned with its benchmark, making it an ideal vehicle for growth investing built on a long-term buy-and-hold strategy. This type of consistency is precisely what fuels sustainable wealth building and long-term financial freedom. From an income and growth perspective, VGT continues to stand out. The ETF offers a dividend yield of 0.66%, with dividends growing at an average annual rate of 14.68%. More importantly, it has delivered an average annual share price appreciation of 17.9%, blending rising passive income with strong capital growth. Using the compounding formula, let's break down what Bobby's $3 per workday or $15 per week investment will look like based on the stated metrics. As a reminder, the compounding formula is simply future value equals the present value multiplied by 1, plus the rate of return raised to the power of the number of years you stayed invested. Now, don't let the math scare you. It's pretty simple. Check this out. To calculate the future value, FV, of your portfolio, you start with your present value, PV, which is the amount you invest today. In Bobby's case, the PV is $15 per week. You then add 1 to your annual return rate, R, expressed as a decimal. For instance, for VGT, the total return is 18.56% annually, which is simply the sum of the 17.9% price appreciation and the 0.66% dividend yield, which becomes 1.1856 when you add the 1. The critical part is raising this to the power n, where n is the number of years. This is where compounding happens. Instead of just multiplying your starting amount by the return rate over and over, the exponent means you're earning returns on your returns. Each year, your previous gains earn returns, creating exponential rather than linear growth. Now, let's apply those metrics using the future value of an annuity formula, based on Bobby's contribution plan of $3 per workday, or $15 per week, totaling $780 per year. After 10 years of consistent investing, Bobby's portfolio will be worth $19,720. At the 20-year mark, the portfolio value would rise to roughly $107,850. After 30 years of disciplined weekly investing, that modest $15 per week habit would compound into approximately $650,438. That's over $500,000 with just $3 per day. But there is more. Claiming the second spot on our list of high-growth contenders is the iShares Semiconductor ETF, ticker symbol SOXX. This ETF is designed for investors seeking focused exposure to one of the most powerful engines of modern growth investing, semiconductors. SOXX tracks the ICC Semiconductor Index, which is made up of US-listed companies deeply embedded in the semiconductor ecosystem, a sector that quietly powers nearly every technological breakthrough shaping the global economy. From smartphones and cloud computing to artificial intelligence, electric vehicles, and advanced medical equipment, semiconductors are the backbone of innovation. This ETF takes a focused approach, concentrating primarily on companies in the semiconductor index. Because of this specialization, the fund is classified as non-diversified, meaning a larger portion of assets is allocated to fewer securities. That concentration can increase short-term volatility, but for long-term investors committed to a buy-and-hold strategy, it also magnifies upside potential. The expense ratio stands at 0.35%, reflecting the cost of accessing this precision-focused growth engine. From an income and growth perspective, this unique ETF delivers a dividend yield of 0.74% and dividends that grow at an average annual rate of 11.45%. What truly sets it apart, however, is its average annual share price appreciation of 19.8%, making it a standout choice for long-term ETF investing and aggressive wealth building. Now, let's apply those same performance metrics using the future value of an annuity formula. Based on Bobby's $3 per workday, or $15 per week, totaling $780 per year. After 10 years of consistent investing, Bobby's portfolio will be worth $21,755. At the 20-year mark, the portfolio value would rise to $137,523. After 30 years of disciplined weekly investing, that modest $15 per week habit would compound into approximately $914,378. That's almost $1 million from just $15 per week. Before we continue, if you find value in this video, even just a little, please subscribe and hit the like button to help us continue to provide more insightful and educational videos. Your support is highly appreciated. Thank you. Taking the top spot on our list and standing out as the most powerful growth engine of them all is the VanEck Semiconductor ETF, trading under the ticker SMH. For investors committed to long-term investing, disciplined ETF investing, and accelerated wealth building, this fund represents a high-octane path toward lasting financial freedom. SMH is a passively managed ETF designed to deliver broad exposure to the U.S. semiconductor industry by tracking the MVIS US listed semiconductor 25 index. Its purpose is clear: capture the full force of semiconductor-driven innovation through a focused buy and hold strategy. With an expense ratio of 0.35%, SMH concentrates heavily on the dominant companies shaping global technology. Its holdings are primarily US listed and include industry leaders such as NVIDIA, Taiwan Semiconductor, Broadcom, Qualcomm, and Micron Technology. Managing close to $20 billion in assets, SMH is one of the largest ETFs in its category. The fund is notably top-heavy, with more than 2/3 of its assets concentrated in its top 10 holdings. That concentration can increase volatility, but during long-term growth cycles, it also amplifies upside for investors who stay the course. From an income standpoint, SMH is modest, offering a dividend yield of 0.48%, with dividends growing at an average annual rate of 12.99%. Where this ETF truly separates itself is in growth investing. Over the past decade, SMH has delivered an average annual share price appreciation of 22.89%, placing it among the strongest long-term performers in the ETF universe. Now, let's apply those same performance metrics using the future value of an annuity formula, based on Bobby's $3 per workday or $15 per week, totaling $780 per year. After 10 years of consistent investing, Bobby's portfolio will be worth $24,578. At the 20-year mark, the portfolio value would rise to $186,237. After 30 years of disciplined weekly investing, that modest $15 per week habit would compound into approximately $1,776,856. This is the compounding power of focused ETF investing at its peak. No lump sums, no speculation, just consistency, time, and exposure to one of the most transformative industries on the planet, making SMH a strong contender for one of the best high-growth ETFs for 2026 and beyond. Now let's bring everything together and see what happens when these three high-growth ETFs work as one combined portfolio, following the same disciplined buy and hold strategy and the same realistic investing habit used throughout. Small, consistent contributions designed for long-term wealth building and financial freedom. Assume Bobby invests $3 per workday or $15 per week into each ETF, VGT, SOXX, and SMH. That's a total of $45 per week, or $2,340 per year, split evenly between broad technology and two semiconductor powerhouses. This structure blends diversification with aggressive growth investing, while keeping the process simple, automated, and sustainable. Using the future value of an annuity framework and the long-term growth rates discussed earlier, the results over 30 years are striking. VGT, fueled by steady technology expansion, grows Bobby's weekly contributions to approximately $650,438. SOXX, with its concentrated semiconductor exposure and higher volatility-driven upside, compounds to roughly $914,378. SMH, the growth leader of the group, accelerates those same weekly investments into about $1,776,856. When combined, Bobby's modest weekly habit grows into a total portfolio value of approximately $3,411,672 without ever needing a lump sum investment. This outcome reinforces a powerful truth about long-term ETF investing. You don't need perfect timing or massive capital to win. You need consistency, time, and exposure to high-quality growth assets. This isn't trading. This is conviction-based investing, quietly compounding, and engineered for financial independence well beyond 2026. If you're serious about building real wealth, then consider this channel your financial gym. Every video is a workout for your portfolio, your mindset, and your money skills. If today's video helped you level up your financial education, even just a little, please smash that like button and subscribe so we can continue to grow and build wealth the smart way. Please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Click on the next video on your screen. Thank you, my friend.